Okay, time to talk about partnerships. Part one. We're going to have a brief look at partnerships and just what makes them a different animal from proprietorships and companies. Well, let's get started on that. So let's see what we can do here. So the characteristics of a partnership are a bit different than we see in a company, which is what you've been dealing with mostly here. Partnership agreements are great when they're actually used. It's one of those things that I think there's a goal for every partnership to have a written partnership agreement that talks about how we're going to work and how this is going to operate. We can have many partners, but it's best to know the rules of the game before you start playing. Some have verbal agreements, which often becomes a problem in time. I've certainly been part of verbal partnerships and seen some challenges there where, it wasn't easy to do things like splitting income. Now, partnerships have a limited life. If a partner leaves or dies, then the partnership's over and it dissolves. Perhaps a new partnership forms with the remaining partners. That remains to be seen. Mutual agency is the concept that every partner is a mutual agent of the firm and can bind the business within the scope of the partner's regular business operations. Now, there's all sorts of challenges in that because you can have a partner of yours who can sign a contract for your partnership that will require you to do something that perhaps you're not very comfortable doing, but if they do that within their regular sort of business operations, well, it's too bad, so sad. You got him as a partner, so you have to make sure that you live up to whatever agreement he signed. Now, unlimited liability flows out of a partnership to its partners. So you can have something bad happen in a partnership, and you can have one partner who has deep pockets who's maybe stuck with paying for all of these problems. So that can be a big challenge for sure. Oftentimes we'll see partners incorporate a company so that that company is a partner in the partnership, and then they stop the liability at that company level, sort of thing. But it's one of those challenges because you can have personal liability as a partner. You got to be careful. Watch you don't lose your house in this, as a matter of fact. And as a result of being a partner, you are co-owners. You are a co-owner of all of the property of the partnership. There's no individual ownership. You can have someone who can contribute an asset to a partnership, but once it's in there, it belongs to everybody. And there's no such thing as partnership income tax. Instead of paying tax at the partnership level, what happens is the income from the partnership is allocated to each partner, and the partner then each pay their own tax on whatever their income is. So they might have some partnership income, they might also have some interest income, might have some rental income, who knows what all they've got for income. But they pay their own tax and they pay on their share of the partnership income. All right, so lots of advantages and disadvantages of a partnership. Many advantages that you can raise a lot of capital because you can have more than one person throwing in a bunch of money. It brings in the abilities and maybe the attributes of more than one person. Sometimes you get the opportunity where there's just a synergy and two people working together, or three or four or five, however many partners you've got in this partnership. Sometimes they can be very efficient and they can actually do better than individuals working alone. Now, many different disadvantages that come out of this. Very difficult to get a written partnership agreement at times. Difficult to outline how that's going to be. And relationships with partners can be fragile. Again, I faced that where you've got partners who get along just fine now, but sometimes as time goes by, it's not so good, and you can end up breaking up a partnership just like that. Now, you've got to look at the liability and the personal obligations for each partner. You need some sort of assurance that your partners are there to back you up, both at work and at home. if there's a challenge that comes up all of a sudden and you need some help, well, your partners have to be able to pitch in. There are other things you can do to help that, life insurance, disability insurance, all sorts of things. But yeah, just know that there's all sorts of personal liability and that flows out of this. And you can have a challenge with a business where all of a sudden a partner leaves and the business is done. It's over with because a partnership dies when one of the partners leaves. So that can be a challenge. Whereas a corporation will continue on. It doesn't matter if someone sells some shares and wants out, or some shares are purchased back by the company, corporation still continues. Now, there are different types of partnerships. General partnerships, where everyone shares the risk, and then there's limited partnerships. Usually you end up with one general partner in a limited partnership, and then the rest of the partners are limited partners. Their liability is only limited to the amount that they put into a business. So if I'm a limited partner and I put $100,000 into this partnership, well, that's fine. I can only lose my $100,000. There are things called limited liability partnerships, and those are things like professional accounting or law firms. And what it does is it really limits the liability or exposure of other partners to what an individual partner might do, and where he'd mess up somehow or have some sort of negligence. So that's often what you'll see in professional firms for sure. Now, partnership financial statements are different. Have a look at Exhibit 12-3 in your text. That's a pretty good example of what the equity section looks like. It looks really more like a proprietorship than a company. It's not as it has the same sort of assets and liabilities that companies have, but it's just a little bit different and looks a little bit more like a proprietorship when we get into things like drawings and capital contributions and that sort of thing. There's a separate section of the income statement where you report the split of income. So you could have an income statement that showed profit $100,000, but you have to determine what the split is between the individual partners. Did someone get 20,000? Did someone get 80,000? Who knows? That's got to be disclosed in a separate section of the income statement. And the equity is not called shareholders' equity on the financial statement. Instead, it's called partners' equity or partners' capital. Now, accounting for partners' initial investments in a partnership, it can be a challenge too. We want to recognize what each partner has put into the partnership, whether that's cash or it's some sort of assets. It could be receivables, inventory, all sorts of stuff, or maybe some property, plant, and equipment or something like that. Plus, they may have added some liabilities in too, or transferred some liabilities to the partnership. But generally, we try and recognize it at fair market value. So every partner is treated fairly in terms of the start of it, in terms of what they've put into it. There can be a little bit of a tax problem for the contributor, but what this does is it really recognizes each partner's contribution to the partnership at fair market value. Now, allocating profits just might be the trickiest part of being a partner. There are many different methods of allocating profits. Can be based on a stated fraction. 3 partners maybe get 1/3 each. Maybe 2 partners get 25% each and one gets 50%. There's all sorts of different ways around fractions. Can be based on the amount of capital investment. So somebody's got $100,000 in there and someone's got $50,000 in there. Well, Mr. 100,000 might get 2/3 of the profit, and Mr. 50,000 might get 1/3. That's another way to do it. And there's also opportunities based on how hard you work. So if one partner works part-time and one works full-time, well, maybe Mrs. Full-time gets more of the profit as a result. And sharing based on service and interest, well, that can be where we recognize that there's some sort of value or some sort of recognition of what the capital is that's invested and getting some return on it. And then we get into losses. We can actually have a loss in a partnership. Well, how do we allocate that loss? Maybe we need a separate sort of calculation for that. But yeah, it's going to be a challenge, and we'll do some of those questions for sure. All right, well, that's the end of our show. Hope you enjoyed part one of partnerships.